All right. Thank you very much. I appreciate everyone coming to spend some time with us this afternoon. I'm hoping I'm going to be able to impart some information that you will be able to use right away. For those of you who do not know me, I'm Wendy Kirkland. I'm a full-time trader. I administer a number of advisories, and I have written a number of books, primarily strategy books. And the one I'm going to talk about this afternoon is the one listed at the very bottom here, Price Surge System. It's a swing trading strategy, and what I'm going to do is to show you both long and short patterns that you'll be able to use right away and implement in your trading. To start with, I'll explain how I came into the market. That most everyone is introduced to the market in one way or another. Some of us may have someone in our family involved. Maybe it's our education or profession. And a lot of us come to it by way of financial need. And that was what happened with me back in 2004. My husband and I ran a gift shop in Biltmore Village in Asheville, North Carolina. And in 2004, in September, hurricane, I guess at that point it was Tropical Storm Francis, came through and dumped unbelievable amount of water in our little area. No one thinks of the mountains of western North Carolina as an area that will be subject to flooding, but we ended up with about 4 foot of water in our building, and it destroyed all of our inventory, the books, our displays, everything. And of course, we didn't have flood insurance. We had liability insurance, but that didn't help. And we had tied up everything in the shop. We had it open maybe at that point 25 years. And so it really was our sweat equity. And when that happened, it just was devastating. Then 2 weeks later, it happened again. First we had Francis, and then Ivan came through. So we had no more than just started, clean out the shop and not even dry out, but to get rid of all the mud and the muck. And it happened a second time. And it was just a real deep blow. And a friend of mine introduced me to option trading, and I took the money that was actually set aside for the electric bill because we had no electricity, so what the heck. Took a few classes and realized that option trading was going to be a really, really good fit for me. I certainly, out of those few classes, didn't get all of the answers, but I knew that I was going to be able to work with this and help bring our family back from the brink. So my personal goal with option trading was to achieve financial independence and to get us out of the financial bind we were in. And within a couple years of eventually achieving success, my desire grew to helping other people. That I knew that I was not the only one out there struggling that needed extra source of income. And so I started writing how-to strategy books, and I do a number of newsletters where I list trade candidates that go with the different strategies, coaching, and then the advisory services. I, too, am posting a disclaimer that it's one that you read just a few minutes ago, but please know that you don't want to trade with money that you can't afford to lose. There's always a risk. And if you'll read through this very quickly, I'll just move on to showing you the patterns. What I have found to be the elements of trading success is, one, to trade options and to gain from the leverage of options. That many of you maybe trade the futures, maybe you buy stocks. For me, option trading and the leverage it offers is the key, and we're going to discuss that and go over it. The other is the introduction of weekly options which happened a number of years ago. They've been around for a while, but the popularity has been like the last 4 or 5 years. So that is the second key, is to buy weekly and front month options, not just the options that are way out in time. And then to trade equities that are primed to have big moves, plus then focusing on my patterns. So I'm going to take this step by step, and we're going to first look at each of these keys to success. Normally in a trading funnel, you would start with an equity, maybe come up with a candlestick pattern, then decide on your expiration and hope everything works out the way that you would like, and your profits kind of come out the narrow end of the funnel. I'm hoping that going to be able to show you how to flip that funnel over and have the profits come out the wide end. And hopefully that's the point we'll be at the end of this presentation. So my first key was the fact of trading options and the leverage that they offer. So let's look at an example here, and if you're not familiar with option trading, this maybe will fill in some of the blanks. In this example, and we'll look at a chart, but let's say that on September 29th, the stock price for Celgene stock was $106.38, and October 5th, it rose to $117.90. That's a $11.52 gain, which is 11% gain. That's pretty hefty. On September 29th, the October monthly expiration for the 106 strike price option premium was $4.15 per share, or $415 per contract, because option contracts cover 100 shares. On October 5th, the bid premium then, when you wanted to sell, was $11.30 per share, or $1,130. This is an increase of $7.15 per share. So that is 172% gain in those 4 trading days. So the leverage that I'm talking about is the difference between buying the stock outright, which you would have gained 11%. That's nice. But here with the options, you gained 172%. So had you invested $10,000, which is what it would have taken to purchase 100 shares of stock, and it earned $1,152, or in this case, your total investment was $415 for just one option contract on those 100 shares, and it earned $715. So for the same investment, the same $10,638 investment that you would have used to buy 100 shares of stock, that's a huge amount, and most traders would not have made that kind of purchase. But we're talking about the leverage here. So for the same investment, you could have bought 28 contracts, option contracts, and earned $20,000 in those same 4 days. So this is what I'm talking about with the leverage. You can buy and control, you can buy an option contract and control the stock for the period of time that you are holding the option and get the leverage of that move. And that is where the high percentage gains can come in. So let's look at Celgene's stock chart here, and we're going to work through this again step by step. But here's September 29th. It's marked with the entry. That's where we're talking about getting in. And October 5th was the exit. So what on this chart would have told you that this is the place to enter? There was a number of days where it dropped and it leveled out for a little while, even started up, and then it dropped again and leveled out and dropped one more time. So what made this time different? And that is what I'm going to show you. So the second element, and this one is several slides, and I hope you'll bear with me, is the benefits of weekly options. And this was the second key. And I've been kind of on a campaign to explain the benefits. And again, if you'll just bear with me, they're new in relationship to the market that's been around for 100 plus years probably. And they've been around, the popularity of them has been around, and weekly options has been only around about 4 or 5 years. So as traders, we're taught not only the value of time, but to make sure we purchase extra time so our trades have plenty of time to play out. And this isn't the thinking behind weeklies. With weeklies, the aspect of time works in reverse. We're not looking for extra time to allow the trade to play out, but providing we have the direction right, we're seeking to protect against the market's fickle change in direction. And we certainly have seen that the last few days in the market. It's been trading in such a tight range. We're using that short expiration to our advantage. So let's look at a few more of the benefits. One is that they're cost effective. They're a fraction of the cost of monthly options. They're exceptional flexibility. They're useful as a trade vehicle for numerous strategies, calls and puts and spreads and covered trades. That long trades are subject to, long-term trades are subject to market changes. And with short-term trades, you trade what the market hands out each day. And since weeklies are new every week, you as a trader can pick and choose to enter the trade the moment that the action is beginning to happen. It's not like you have to get in and then you maybe hold through a consolidation period and then finally it gets going. That weeklies, you just kind of zero in right at the moment that it's getting ready to explode. There's no need to tie up your capital, as I was saying, waiting through a pullback or consolidation period. You can enjoy 52 expiration periods a year. Weeklies are available on the indexes, on stocks, on ETFs. The exchanges offer new weeklies on companies every single week, and that way you can get on some of the things that are drawing a lot of attention and have a lot of volatility. 1 week a month, all optionable equities become weeklies. That's the third week of the month when the monthlies expire. Weeklies are a short-term chartist dream because all you have to do is ask yourself, where will this equity be in a week or less? The shorter the time frame allows for more accuracy. Weeklies can be used in conjunction with news events, earnings report, FOMC minutes, like Yellen tomorrow would have been a trading opportunity with weeklies. And they remain more reasonably priced during periods of higher volatility. And once the news is released, weeklies suffer less of a volatility crush than monthly options do. Just a few more advantages. Greeks, the weeklies inherently offer a greater delta than the monthlies do. Weeklies don't suffer from high theta, but time value is less of an issue. With cheaper prices, it means you can purchase more contracts for the same total investment. We looked at that in our example. An additional benefit is the gamma is explosive with so little time value. And quick price moves before the market can change direction compounds the benefits and the leverage of option trading. And recently, the exchanges have been given permission to offer weeklies 5 weeks out in time. But you want to not go too far out in time, or you might just as well buy the monthly. So you want to really stay close to the move of the price in the stock. So these are now the elements. Next we will cover the third one, which is the patterns. But the overall wealth building strategy is utilizing the weekly options, incorporating my special patterns, and then applying the strategy that support this goal as far as building wealth. So I'm going to reveal to you the steps that I use, and you have to understand that there's always going to be a few losers, but when you win most of the time and have stops in place, the winners are going to outpace the losers. That having a losing trade is just part of the game, but you want to cut that short. I hear from traders every single day who are experiencing great success using this strategy, and the things that I'm hearing from them are life-changing as far as some folks being able to quit a job or add what would be extra paycheck each week. And I want you to understand that I consider myself to be the everyday retail trader. I am just like you. I still just trade a modest amount in each trade. And for all of these examples, I'm going to be using, say, in the price range of $600 per trade, which is an amount that would fit in a modest trading account and allow you to buy a couple contracts. So we're not just have the advantage of option leverage, but we have the weekly option leverage. So I want to show you again a trade purchasing the weekly options. And so I've kind of discovered or figured out that if you have a 2.5 the price move, it will often equate to a double in a weekly option premium. So the key is to look for stocks that have consistent large moves. And the price surge system that I mentioned earlier shows you how to do that. And so in our next example is going to be Home Depot. That's a company we all know. And we purchased calls on mid-trading day on September 30th for $1.55 per share. So that's $155 per contract for the October 15th monthly, which is about 2 weeks out in time for the 115 strike call. And let's say you bought 4 contracts for a total investment of $620. That's in that $600 range. And you sell at the end of the day on the 13th. And this is 3 days before expiration. The call contracts are then worth $6.15 or $6,150 for a total gain of $5,530 or 892%. That is crazy percent gain. And so Home Depot, when you entered the trade, was $112.50, and you sold at $121.50. So that's a $9 change in price. That's a hefty 8%. Here we're talking about 2.5 to 4, and this is an 8% increase in the stock's price over those 10 days. And yet the option increased 892%. So this is the life-changing kind of moves that you can get and zero in on through the patterns that I'm going to show you. So for those 10 days, you controlled $45,000 worth of Home Depot stock. And you did that for, what was the total? Total investment of $620. That is the leverage. That is where it comes in, because you capitalize on the stock's move for having an investment that would be like a down payment on the stock. So here's Home Depot's chart on the 30th. And again, I ask, what's going to show you that it's getting ready to move? And we're going to add some indicators here that, it has gone up, it's gone down, up, back and forth, up again and down. And so at this point, we're going to add the PPO, which is the percentage price oscillator, PPO. It's like the MACD, and you read it in the same way as the MACD, that price is going to flow in the direction of the cross of the black line over the red. And I'm just going to tell you, my books are written very simply, that I explain things in everyday terms like you and I are sitting across the kitchen table from each other. So here you have the PPO on the 11th of September crossed up, and here it came down and it tested the PPO on the 15th. If you look up at the chart, you can see that the price moved up, it tested, and then it bounced off of that line and continued up, and you have this rise. Then you have a PPO cross down, and price moves down. Here you have on the 25th, you have a price move up, and on the 28th, you have a cross down. It's that simple as far as reading the percentage price oscillator. So here I'm adding a second indicator. This is the average directional index, ADX. And the way that you read the ADX is a strength line. When it is rising, strength or momentum or energy or whatever words you want to use is going into the trade. Anytime it drops, energy is coming out of the trade. Strength is coming out of the trade. So what I'm going to draw your attention to is the pattern that is created between these two indicators. The indicators don't necessarily have anything to do with each other, and yet they create an interesting pattern. And it is right here. I call this a squeeze. You have the PPO has dented down like this, dropped. You have had the ADX rise, and they have come in together to squeeze close to each other. There's actually another one here at the beginning of September. The lines have come very close together, and when the lines push away from each other, price goes up. Here you have the lines pushing away from each other, and price has gone up. Here is the same chart. We've just given it more time. We've moved out into October. Here is your squeeze pattern right here. The line has come down, and ADX has risen, and they make these peaks that come very close together, and then they start pushing away, and price goes up. So now I don't probably have to show you a whole lot more than that, but let's just look at a few more. This is Boeing, and you have the squeeze right here. I can actually look, and without it being circled, there's actually another one right here on the beginning of September. And then the lines push away and price goes up. Let's look at one more. This is Monsanto. This one, the lines got started, pushed away from each other, started going up, and then it actually failed. PPO crossed back down, created a new squeeze. And that one is even tighter. The lines are coming even closer together, and then it got going and unfolded and played out. Here's one more. This is Starbucks. The lines coming down and the ADX rising here creates the squeeze pattern. The lines push away from each other and price goes up. So the part of the strategy, and I'm not covering everything that's covered in the PSS or price surge book. You can't do that in the 45 minutes or so that we're going to be here, but you can already spot and see how you have this pattern form, and then you want your confirmation so that on the previous chart I showed you, let's see if I can flip back to it. I guess it was 2 above. Here you had Monsanto just got started, and chances are you wouldn't have had a confirmation on this trade, and so you wouldn't have gotten into to that. You would have known that it was early yet, and you would have waited, and it would have been maybe on your watch list, and then you would have gotten in on the second squeeze that had a better chance of playing out. So here you have the squeeze again on Goldman Sachs. Lines push away and have a very nice rise in price. So this is a brand new squeeze. Instead of me showing you what they look like after they've played out, I mean, hindsight is beautiful. This is what Visa would look like. And you can see how the lines have come very close together. This is a nice tight squeeze. So this is what you would be looking for. And it hasn't yet started into what I call the birthing process, where the lines push away from each other to get the pattern really started.
Hey, Wendy.
So here it is.
Wendy, I apologize for interrupting. We do have a quick question from Thom. He asks, is there a minimum for the ADX to reach numbers-wise for it to qualify as a strong move?
There really isn't. That part of this pattern is the fact that the PPO and the ADX don't really have anything to do with each other. They're individual to the equity. And if we were to flip back or on the charts that we continue to look at, you'll see that the ADX numbers vary based on the stock. So it's really a visual pattern that is created. That you can maybe find something that would be a mean, maybe 20, above 20, but on the different equities, that amount is going to vary. And we'll look at that as we scroll along here. But again, here's the squeeze that we looked at on the previous chart, and we looked at it here where it was just getting started. The lines push away from each other, and price has moved up. So on the trade that we just looked at, and I showed you how the pattern started, again, keep in mind that the 2.5% to 4% equity move often will double an option premium. So we purchased mid-morning, not at the, instantly, but after the market opened, contracts for $1.23 per share. That's $123 per contract for the October week 2. It expires on the second Friday of the month of October. 69 strike call. And let's say you bought 5 contracts for a total investment of $615. Again, that's keeping that in that range of just kind of an average trader. And you sell on October 9th on expiration day. The call contracts are worth $4.70 or $23.50 for a total gain of $17.35. That's 282% for that move that we followed on Visa. When you entered the trade and the stocks were $68.50, and when you sold they were $74. So that was a $5.50 change in the price. That's, again, 8%. That's up above our 4 that we are kind of looking at for to have a double in the premium. But over those same 10 days, the option premium gained 282%. So again, that's an example of being able to zero in on stocks that are going to move, get the direction right based on the pattern, buy contracts within your total investment amount that you budget, and you are able to have this increased leverage that option in general offer. So I want to point out and make sure you understand that the pattern can occur in any type of equity. That this is IWM, this is the Russell ETF, and so here you see the squeeze pattern. and is pushing away from each other, and price has gone up. It works out in any time frame. So let me flip back. The Russell was a 60-minute chart, and here's a 15-minute chart of Monsanto. So here again, you have the squeeze form, lines pushing away, and price goes up. Here's a 5-minute chart. This is a Visa 5-minute chart. There's a squeeze. Here's another one back on the 13th. Lines pushing away, and you have that pop. So when you are scrolling through a watch list, scrolling through a list of charts, whether, to me, the best option is to get the newsletter that I put out on Monday and Wednesdays that lists equities that are creating these patterns, so it saves you time from looking. But when you see a pattern forming like this, creating the squeeze pattern, then it's time to look at the confirmation signals to make sure that everything is lined up and it has the best chance of playing out. And I say that, I'm going to point out, I found a couple. Here you have a squeeze and the lines kind of pushed away, and yet what happened was price went flat. It just wasn't ready. Here's another example. A couple days later, the lines kind of pushed away. It started going up, but it still wasn't ready. And then you had the third one form, got started as the lines were pushing apart, and it went up just a smidge, and it flattened out again. And chances are, with the confirmations, you would not have entered any of those trades. That you would have waited until you had the confirmations that you needed. Here's another example. This is Citigroup. And sometimes when they are going to, if you want to say fail or not really get started, they happen kind of in a series in a row. And so you really need to wait until you have the confirmation signals. I put there that the signals are as clear as a red light and a green light, meaning stop, don't enter this trade, stop, don't get in yet, stop. And then eventually the green light will go and you know to enter. So price search system, or PSS as I call it, utilizes this reverse funnel by applying not only the P3 squeeze that we've been talking about, but also the P3.5 pattern, so that you can trade both long and short. All of the trades, all of the charts that we looked at prior to this were showing the market or this equity being ready to move up. So repeat here that under normal, you're having zeroing in on the equity, you have a pattern, you decide on your expiration, and it flows out the narrow end of the funnel. So with the PSS, what you're doing is you're finding stocks with big moves, you're applying the P3 and the P3.5 patterns, and you're zeroing in by trading the weekly and front month expirations. And having those elements pushes profit that they multiply and have that leverage that we've been looking at. So I introduced you to the P3 squeeze, and let me flip back here. And so let's look at the P3.5. Well, goodness, it's so sensitive. The P3.5 pattern that, again, you have the PPO cross down, which means price is apt to go down. It follows the direction of the PPO. And then we look for the spread apart of the ADX and the PPO, and you have strength and momentum coming into this drop. And so you have the downside. Let's a couple more. That here you have the PPO cross down. This is the squeeze where the lines are coming, and you have the push away, and you have the drop. And this too has the confirmation signals. So in the price surge system book, you have, it's 145 pages with lots and lots of illustrations. It goes over the patterns. It goes over all of the stages. There's a DVD that details, again, some people like reading things, other people like to see things, so it goes over both the long and short patterns. It highlights that there is stages in every single pattern, and it allows you to have a level of comfort. One, it gives you your entry. It gives you your stop. It can give you actually a second entry if you miss the first, and you know with comfort that you can get in at a little bit later point. And then there's a point where you can relax, and as long as the lines are lining up, you can just take a deep breath and say, okay, it's doing what it's supposed to do, it's unfolding in my direction, and then you have your exit. And it goes through all of this information. And it is the same with the P3.5 short. It's just as clear a picture and gives you all of the same stages of entry, second entry, stop, comfort level when you can relax, and your exit. So the whole point of being able to slip through the narrow end of the funnel and come out with a burst out the wide end is the fact when you apply both of the patterns to a chart, you can ride a wave up, you can ride it down, you can ride it back up again, and you know exactly when to get in. And so that, look at this period that's here maybe between the 18th and the 26th or somewhere in there. Instead of having your money tied up during that period and then maybe sweating the fact that your expiration is going to expire and what are you going to do? You need to sell for a loss because it's just not going anywhere. It's consolidating. These patterns are giving you the red light to go ahead, telling you when to exit, giving you the put entry time to get in, telling you the exit, and riding it back up again. And often you will be able to take a few stocks and be able to do this, ride them up and down. So what makes the price surge system special to me is that you have this chart set up, that you establish your template, your chart template, and apply the stocks, equities to, that covers everything as far as the stages for both the long and the short, tells you alerts as to, okay, this is setting up, and then you have your confirmation, and it goes through all of the stages. Then you receive a weekly newsletter on Monday and Wednesday afternoon of stocks that are starting to set up these patterns. It's not telling you after they've already unfolded and played out. This is ones that are setting up that then you would put on a watch list, add them and run them through your template, wait for those confirmations, and then get in. And so with being able to trade long and short, being able to have a newsletter that gives you candidates to trade, you always have a trade that's brewing, whether it's up or down, no matter what the market is handing out, and you become an expert on these patterns and being able to trade in both directions. And for information, you can jot down the phone number or email me at the support here.